We can look at the expected move here on the right side. It's giving us a dollar value, $18.25 higher or lower than the current closing price of 188. But it also has a market maker move. So now we can add that $17 market maker move with this $18 two-day series expected move. And we got a pretty good idea of what Qualcomm could make in the next 2 days. That's not bad, right? We're looking at $30 expected move. Right, is that right? 35. 15 and 15 is 30. So 20 and 17, 37, right? 35, 37, something like that. Higher or lower. That's one direction. Now, places like Tasty Trades or, Tasty Works, Tom Sosnoff, they point out the old school way of answering this same question. The old school way when it comes to answering how far could price move during earnings. Well, back in the day, they didn't have these fancy tools called market maker move, and they didn't have these options, implied volatility calculations like they do now. So what they used to do back in the day is they would go in and they would run a strangle or a straddle right at the money. So this straddle is $20. That's today, right? It could move $20 higher, $20 lower today. And then back then they didn't have the MMM, but you could do that too. And then you could say, all right, well, that's 20 plus 17. It's a $37 move higher or lower. If it moves that far, we're talking about a 1 standard deviation move, meaning 70% of the time it should land in that range, and it would not even be considered too far, right? This is a $188 company, and it moved $11 today, and that was a 6% move. If we're talking about a $30 move, we're looking at like an 18% move in Qualcomm. That's a big move. But if it moved that far, it wouldn't even be considered big. Like, that's all it is? All right, then nothing. So what would a 2 standard deviation be? Well, that would be 95% of all price action. Now you bring it over to the Analyze tab, and we get this thing out of the way. The gray area that you see here, that is a 1 standard deviation. So I can come in here, I can set the slices, and I can say, show me a 1 standard deviation. Now my price slices line up with these lines. That's how far we could move. And that's 68%, 1 standard deviation. But what if we went in and we adjusted that to 95% probability, meaning 95% of all price action is expected to land inside of this box. Now the box is much bigger. And we can set our slices there. That would be a 2 standard deviation move. 95% of all price action is going to land inside of that box. And it would still not be considered an outsized move. It would still be just considered like, oh, wow, it made a 2%, two standard deviation move. That's a pretty good move, still not extreme. There is a probability analysis. This is the same cone that we were looking at in purple out on the chart. Only this cone, I can actually go in and adjust how many days we want. Today's February 2, here's a February 4 line, and it says that we could go to 192, or we could drop down all the way to 155, 155, and it would still be considered normal. And that's a 95% probability. It's a 2 standard deviation. If you haven't caught on yet, by the way, standard deviation is a very, very important calculation, and it's used everywhere. VWAP, Bollinger Bands, Keltner channels, acceleration bands, everything uses standard deviation. So when we're trying to look at an earnings trade, we do want to know what that range is, because, if we were to want to buy cheaper options, what if we bought options on the edge of the expected move? That way we're going out of the money buying those cheaper options, and we do have an idea of which options to buy rather than just like, well, this one looks good. So it could get you lined up so you know which option to be focused on. You could also put butterflies at those locations. You could build your iron condors around those locations. And instead of selling the iron, you could buy the iron beyond those locations, right? But a little tip, don't trade an earnings trade that needs volatility to go up. Those kind of earnings trades are going to get punished really hard when volatility goes back down, which is what it does when we have earnings. The volatility that I'm talking about is something that you can visually see using the implied volatility indicator. Depending on your broker, it's not really looking at volatility. So, don't assume that this is actually options volume. It really is reading the candles. It's not reading the options. They didn't have that ability back then, but they called it implied volatility, and everybody makes that mistake. Now look at Qualcomm on this earnings in July. Notice after it had the earnings, it got severely punished in the volatility. This big drop. It's called a volatility crush. So it reports earnings, volatility gets whacked. If you're new to trading options and you're not quite sure how this affects options, think about this candle chart. So it's candles, and everybody's like, thanks, Captain Obvious. I understand what a candle is. It's green, it went up. It's red, it went down. Candle. What if I turned this candle into a line chart? You would still understand exactly what we're looking at, right? You're like, yeah, I get that. This is the price of the stock. As it went up, the line went up. Got it. Captain Obvious. Well, this is the price of all of the options in an aggregate perspective. Not one call, not one put, all of the calls, all of the puts. In general, in aggregate, are all those puts and calls gaining value, or are they losing value? If this is pointing up, then they're all gaining value. That implied volatility is a direct representation of their cost, not value, of their cost right now. And when it takes a volatility crush, when it has earnings and this thing dips to the downside and drops 15 points, that is the value of all of your options dropping to the downside, right? So if you was just to go buy a call and this thing skyrockets to the upside, sure, your call is going to make money because price moved up. But your call is also getting stripped of a lot of the profit you should have kept because you got vol crushed. So when you're building an earnings trade, you want to make sure that it's a trade that benefits from the collapse of volatility, or at least is protected from that crash in volatility. What kind of trades does that? Iron condors. That's one of them. So does credit spreads, butterflies. To visualize what that looks like, we normally sell a credit spread and iron condors. So if I was to take this iron condor, throw it into the analysis tab, that gives us this little tent looking thing. So we got the TP right here, and we want to be able to ask a question. If volatility does go down, what is going to happen to my trade? We go to vol step, take it to number 4, draw the line. Each one of these lines represents a different value in volatility. So just looking at that, look at, I'm not even going to move my mouse yet. Let's just do it easier. I do it this way. And we'll zoom in to the corner. If the volatility stays at 60.31, then we're at a particular price. I didn't have the price showing because my mouse didn't get caught, but it's doing 5 steps for every volatility line. Green, the white, the yellow. We're going from a 60 vol to a 65 to a 70 to a 75 to an 80. Notice that number is going up, by the way, not down. So this is showing us a volatility spike, and it's helping us answer a question. What will happen to my iron condor if volatility went up? Well, we can see if volatility goes up, our iron condor, the profit in our iron condor would go down. We would lose money. We don't want to lose money. We want to make money. So if volatility does rise, our iron condor would get hurt. But what if volatility falls? So we're going to put a minus sign in there and come back and keep my mouse in the same spot. If we go from a 60 vol to a 55 vol, this losing trade would go from a -4 to a -3. So it's getting better. If we drop from a 55 to a 50, my losing trade will have lost less. And if we actually drop 20 points of volatility, my losing trade would suddenly become a winning trade. So we can visually see when volatility does fall, this trade would make money from that fall. This is a trade that would benefit from a volatility crush. If you're going to trade earnings, you definitely want to know what's going to happen to my trade when volatility gets sucked out of these options. Is it going to hurt me or help me? Now, you may not be able to get a trade that will benefit from the volatility crush. Like maybe you want to put on a call debit. That's definitely not going to benefit from the volatility crush. But the debit would actually be better than the naked call. Yeah, it's going to cap your profit, but it's going to protect you from that slippage. And the profit you get will actually be your profit, not profit you should have made, but you lost from the strippage. And if you did want to get a call and you decided to do a spread, well, imagine spending $1,385 to buy that call. Or you decide, yeah, I want a call. And so you come in and you build a spread. Well, that's $100. I could buy 10 of these, right? I could buy 10 of these and still not have spent the same amount of money. Now I can fade the play. I don't have to get all out all at once. And this trade has the potential to make an easy $100, right? It's got a max profit of 150, but we could easily get 100 of that. So even though you may not get a trade that will benefit from a volatility crush, you definitely want to put on a trade that won't get hurt from the volatility crush. If you're looking for a lottery play, since we did talk about these ranges and these moves, going to the edge of that move and putting on your butterfly would be a really good way to go, because butterflies are cheap, right? It's one of the cheapest trades that you could put on. We're talking about, oftentimes $7 or $8. This one's not even hitting $1. So if we worked the order, we could get a butterfly where we are literally risking $1. You can't even go to McDonald's and get something for $1. Your commissions will cost you more money than that. And if you're wrong, whatever, you'll sleep good, right? You're only risking $1. Even in that tiny, tiny little butterfly that I just built, it has the range, right? And we can ask that same question. If volatility was to get crushed out of this trade, would it help me or hurt me? It will help. We can see that the numbers are going up. So it's another trade that would benefit from a volatility crush. So what about when it is going to report? Can we game the system and maybe have an idea of what direction it's going to go? Because so far, I've really been talking non-direction. In fact, I've been basically talking neutral. It could go up, it could go down. We can make money in either direction. Is there any way to anticipate which direction this thing is actually going to go? Most people are going to tell you no. The reason they're going to say no is because it's not just about what Qualcomm did in the fourth quarter. That's a big part of it. That's true. But that's not all of it. We also need to be able to answer another question. What are they going to do in the next quarter? That's just as important. And if they don't present that information in a way that investors like, they're going to dump this stock. Even if it's good news, if they don't present that good news in a way that investors like, they're going to dump this stock. So when you're trying to make a decision about, should I buy this for earnings, or heck, should I hold it? I already got some. Should I hold it for earnings? You can't game the system and try to figure out where it's going to go based on what they have been doing or what you think their last quarter was. And it's a very closely held secret of what they think they're going to do in the next quarter. They don't release that information lightly, but they do release it. That's a key that I'm going to point out here. There are institutions and agencies whose sole purpose is to monitor any news from a company that's going to report earnings. And a lot of these institutions, these companies, will give you the information early. So for like example, Apple will come out a month before earnings and they'll say, hey guys, we don't think we're going to hit our earnings target. So we're going to reduce our target now before that earnings. And of course, their stock will take a nosedive. Everybody will talk junk on Apple. And then since they lowered the bar, earnings will come along and they'll say, oh, look, we beat our earnings estimate, and their stock will rally right back up again. Companies put out forward earnings expectations all the time. But because of the flood of news that's coming at us nonstop, 24 hours a day news site, it just gets lost in the weeds. You got to be able to pull that information out. One of the best places to go to is the Earnings Whisperer. Now, I'm not going to do a commercial for these guys, but they're good. They're really good. The entire sole purpose of this website is to focus on earnings. Any news that has come out from the CEO, CFO, ex-CFOs, they don't care where it comes from, as long as it's legit news or an honest perspective, they're going to grab it, capture it, and provide it to their customers. So if you're looking to do an earnings trade, you could not get a better source of earnings information than this place right here. It's not free. They offer a little bit of free stuff just to kind of tease you on things, but the good stuff is hidden behind a subscription that you have to get. They have 3 different kind of subscriptions. They got like your general all-purpose, really cheap subscription. They've got a trader's subscription, and then they've got like an investor service subscription. They'll do earnings trades, earnings trade call outs, just, like all kinds of stuff. I've never had a full subscription, but I've had one of their cheaper subscriptions. And even that was wow, right? Like they produced some amazing content, even on the cheaper end. But you get what you pay for. So if you do, go all in, you'll get the works, and it's pretty amazing stuff. If you're going to focus on earnings, that's a really good way to go. If you don't want to do something like that, perhaps something like FinViz Pro. These guys are more of an aggregate news service. They're not going to give you one perspective. They're going to give you every perspective that they can get, right? So then you go in and you do something like Qualcomm, and it's going to present you with everything that it's got. News, insider buying, aggregate sources of information from Investors Business Daily, Yahoo Finance, Guru Focus. I mean, down the list. If they've got it, yep, Tip Ranks is on there. If they've got it, it's going to land in here, right? Now, they don't have a subscription to everything, but this is more of a scatter plot, right? It's going to try to offer you as many perspectives as it can from as many aggregated sources as possible. For someone like me, that matters, right? Because what I don't like is a place that tries to spoon feed me their narrative or their perspective or their agenda, right? Like maybe they get paid to talk good about Ford. I don't care, right? I want, give me some perspective, more than one opinion. So something like FinViz gives you more than one opinion, and I appreciate that. So Earnings Whisper is like a laser focus right on earnings. That's the only thing they do. And you got to appreciate that, right? Because I do like the idea of being kind of good at a lot of things, but man, when it comes to my money, I want to be really good at one thing. And so, if they're going to offer earnings and that's the only thing they offer is earnings, they're damn good at it, right? And they've been around for a long time. They've got a lot of history. So, that's a good way to go. So hopefully this will give you some perspective, but we're not quite done yet. What else can you get for an earnings announcement? You can see earnings is coming and you're thinking, yeah, man, I want what you got. Look at the top of your Thinkorswim in the left side, go to the analyze, just hold your mouse there, right? Like just come up and move your mouse around. Go to analyze, earnings. No, Thinkorswim has an earnings tab. So now you can go in and you can look back in the past. What was their last couple of earnings? Not only what they actually did, which is the yellow or the orange line down here, but what do we think they're going to do? And that's in blue. At each one of their earnings, there was the Wall Street estimate, and then there was the actual what it did. And we've got 2 years of history here. It also presents you with the volatility spread in red and yellow. And then it has the at the money straddle, just like I built. Remember when we went in there, we built that at the money straddle. It has one of those for every earnings in the past. So this can give you an idea of what they think it's going to do. And it even has, like today's earnings listed, February 2nd, has the market maker move up there. They're trying to offer you as much information about this company's earnings as they can. What else do we got? We got the Analyze tab. So when we move our mouse there, we've got fundamentals. So you can go to Qualcomm and look at their fundamentals. There are 4 research companies right here who will offer you their perspective for free. Now, Market Edge does have a paid service. So, you know, they're only going to give you some of theirs for free, not all, but even some is better than nothing. So we can look at this. One little tip though, make sure the date is good, right? So I'm going to take a picture and zoom in on this. Notice the CFRA report is still last month's. Oh, that's so last month. Yeah, it's a week old. You know, research team, at least it's also a week old, but it's the newest one on the list. Market Edge, January 28th. The Street, January 23rd. So when you're looking at these, make sure they're as current as you can get. I have found some that are really old, and it sucks, man. You click on it, you download it, you open it, you're reading it. 10 minutes in, you're like, oh, shoot, man, this thing's 3 months old. Never mind. You know, and it's just like a big waste of time for nothing. So just check the date before you download it. Make sure you're getting something current. On the Market Edge, it is the free one, right? So if you had a Market Edge subscription, you would get a much more current, accurate perspective of its earnings. On this area, by the way, you can also go in and you can look at where their money comes from. Like, what do they do? You know what I mean? Like, you know, Disney has cruise lines, theaters, you know, resorts, hotels, theme parks. When you're looking at a company, you don't always know what their widgets are. So you can take a look at what their widgets are, kind of think about where their money is going to be coming in. If it connects to something that's already recently had earnings and what it's been doing, if it's getting into new branches, that's a really good perspective, right? So a lot of really great information provided for free. You know, you don't even have to go anywhere to get the information. Some of them even offer you a chance to reshape where they're putting their money, right? So like this little Trepis estimate, I could go in and say, well, I read a news article that they're going to get rid of their mobile devices. I didn't, but you know, suppose we had read an article that said they were going to do something like that. We could actually go in and we could start to remove how much we think they're going to be invested in chipsets, right? Something like that. We could actually go in and adjust that number. So a lot of really neat things that you can do when it comes to Thinkorswim for earnings. And hopefully what this is showing is there's a lot of things that can prepare you for an earnings event, how far it can move, what our trade could be worth, what strikes we should be picking if we're trying to put on like iron condors, butterflies, how much of a volatility crush we're expecting to take. All of those can prepare you for the anticipated earnings announcement. One thing that's a little redundant, I don't know, I don't have a word for it. If a company misses, a good miss, right, like a positive miss, and they get a gap up like we had back here. The first time it happened was actually back here. They missed. It was a positive miss, kind of gapped up, but the market thought about it, didn't like it, and faded back off from there. The next time it missed and it was a positive surprise, big move. Well, here's the neat thing about retail traders and big moves. It did it last time. Everybody thinks it's going to do it this time. And they'll go in and start buying this sucker up, looking for that big move again. What you'll find because of that is you'll often find 2, 3, 4 earnings in a row where the amount of volatility crushed out of the trade gets bigger and bigger and bigger until finally they don't get a surprise miss. Everybody gets butthurt, slams this thing back down into the ground, and it starts to look like Facebook. Right. So speaking of Facebook, the first time I had ever seen a company present positive news, and I mean, it was really, really good news, and still lose, was on Facebook. It was really big news at the time because there's other, so a little backstory. Apple and Microsoft report first, right? And there were these two college kids in 2018 who basically mortgaged their house, took their college savings, and instead of doing what they should have done with it, they bought a bunch of Apple calls. The kids turned into millionaires overnight. I mean, it was a big story. It was all over the news. These two cowboys bet the farm on an Apple earnings and blew it out of the water. So some guy in another country was like, oh, Facebook's about to report earnings and they had a great earnings. I'm going to do that. And the guy went in and leveraged to the hilt that Facebook was going to have a good earnings. Spoiler alert, it wasn't a good earnings. It was actually an amazing earnings. But during the presentation, Facebook made one bad comment. Their earnings estimate for the next quarter, they said, we expect to make, like, don't quote me, the numbers aren't going to be perfect, but we expect to make something like 21% again next quarter. And that was about their average at the time, 21, 23. And everybody's like, yeah. And then Facebook said, but we're going to spend probably 4% of that because we're going to branch into this new venture. Down it went. When they said they weren't going to actually capitalize on that 21%, that's all she wrote. Now think about what they said. We're going to make around 19%. 19 in that earnings period, Apple did like 7% and went through the roof. These guys said they were going to make 19% and it dumped. So this is a really good warning. It doesn't matter how good the earnings is. And it doesn't matter what you think their earnings are going to do. If they present their forward future earnings in a way that the market does not like, it's going to go down. It could be really bad news. And if they present that good, it can go up, right? So it has no direct connection to the news itself. It's how it's presented. The warning here is don't think you know what a company's going to do. Don't bet the farm that it's going to do a particular thing. I mentioned that this guy was out of the country for a very specific reason. In America, if you don't pay your bills, they send lawyers after you. In the country that guy was in, they didn't call lawyers. They went after the guy. Can you imagine living in a country where you don't go to jail, you just disappear? That would suck. When you make a trade, your broker's on the hook, right? You may not know that, but they're vouching for you. That guy's broker had to up the fees on everybody who was in that broker, and suddenly like, okay, guys, you all owe us a lot of money because we got to make back this big loss. I don't know what happened to the guy, right? I don't think any of us ever want to know what happened to the guy. So now you've got a better perspective of earnings, its range, where to find more information, how to gauge where your strikes may need to be landing at, and maybe a better way to trade it, right? Or at least a less risky way to approach it. I obviously have put a lot of work in looking at earnings. That's why I was able to run through this so quickly. Usually once or twice a year, we get a new group into the Bullish Bears who get kind of excited about earnings season. And so we usually end up having this conversation. I do have earnings trades on the Next Level library, or at least earnings videos. So, you know, if you were to log in, go to the Next Level library, options. Guess we got to search for it. So this video is one called Why You Should Not Do Credit Spreads During Earnings. Totally worth watching because it explains why you don't want to try to use that volatility crush. And it's mainly focused on the trade before earnings, right? Like we see that volatility ramping up and we're thinking, oh yeah, man, I'm going to sell a credit spread and I'll get out before earnings. That's what everybody says. I'm going to get out before earnings. No, you're not. Because see what happens is you sell the credit spread before earnings and it doesn't decay, right? So maybe you go $5 wide, you collect like $1.50 in credit and it doesn't decay. In fact, every single day, it just keeps getting more and more expensive. Well, if you buy it for $1.50, you need to, or if you sell it for $1.50, you need to buy it back cheaper to close for profit. If it goes from $1.50 to $2 and then $2.25 and $2.30 and $2.50, you're not getting out of that thing because it's getting closer to earnings. And remember, this blue line represents the aggregate value of options cost. The closer we get to earnings, the more that all of those costs went up. Another thing about earnings is the expected move. And we talked about it, right? It was kind of where I started. This expected move is how we do the square root of time. They know that everybody's using that square root of time. And they want to hold the expected move as stable as they can for the bigger institutions. So they actually manipulate the Greeks. This is not some kind of tinfoil hat conspiracy. I'm going to show you that they manipulate the Greeks. All right. To be able to demonstrate this, we need a couple of numbers. Make sure I don't delete my notes. I've got a new video coming after I make a new indicator. Somebody gave me a really good idea for an indicator, and I got to get my notes are on that right there. So I'm going to show you that they manipulate the Greeks. It's not a tinfoil hat conspiracy. The way it works is the more time we have to make a move, the farther a market could move, right? This should make perfect sense. If I ask you how far a market can move today, we could say something like, oh, 4%, that's not out of line. How far do you think I could move in a month? 20 times that, right? Because if I can move 4% in a day and I got 20 days, I could move much, much farther in a month. So the farther out in time we have, the bigger the expected move. That makes perfect sense. Look at the price tag, $18 expected move for 2 days, $20 expected move for 9 days, 23, 24, 26. You can see how it's going up. The farther out in time, the bigger the expected move. That makes perfect sense. It's also directly connected to volatility. So when the volatility is high, the distance that we could make in that time period, that also goes up. As we come into earnings, the number gets really big. I mean, look at right now, it's at 140. That makes perfect sense. So let's look at Qualcomm and let's go back a month. We'll go to the Analyze tab, go to Think Back. We'll just rewind time. Let's go back to the first of the year, January 3rd of this year, Qualcomm. Now, normally I use Google for this example, and I may still have to go to Google because this manipulation is not something easily seen in every market every time. But I know exactly a spot in Google where I can demonstrate perfectly that it happened. But we're going to try Qualcomm. Remember the date. As far as these options are concerned, today is January 3rd, 2022. Okay. We know earnings is on February 2nd. So we're going to look at the Feb 4 earnings. A $19.43 expected move. And it's got an IV of 43.69. So that makes sense. And just to keep track, this is 32 days out. So let's go forward. That's 32 days away. We'll jump forward 1 week from the 3rd to the 10th. Now we're 25 days away from expiration. We have an expected move of $19.63. And that's an IV of $51.65%. So what this is telling us is that the implied volatility increased almost 10 points and the expected move didn't move. Wait, what? We're closer to expiration. That expected move should have gone smaller. Or at the very least, we're 7 days closer to expiration and our implied volatility changed by 10 points. This thing should have done something. Nope, the EM is exactly the same. Okay, maybe that's a coincidence. Let's take it another week. So here's January 17th. That happened to be a holiday. We'll just take it one more day to be fair. It's an open day, right? So we'll go to the 18th for this day. We're now 17 days away from expiration. We've got an expected move of $18.90 and an IV of 60.39. So again, the implied volatility went up, our time to expiration went down, and our EM dropped. Well, if volatility goes up that much, your EM should go up. It didn't, it went down. They're trying to stabilize the distance of that expected move. We'll take it another week. We've now got a $19 expected move and a 78%, almost 79. So the expected move is still holding right there around that $19 mark. Now we're on the 31st. We're 4 days away from earnings at this point. Or from this expiration, right? Not from earnings, but from expiration. We've got a $12 expected move. Like, wait, what? We were just so much bigger than that. We'll back up. We had a $19 expected move here and a 78% implied volatility. This is 11 days to expiration with an EM of $19 and an IV of 79. We'll just round up 79%. And then we're going to jump forward just 1 week. And now we've got an 84 volatility and a $13 expected move. What? See how manipulated this entire thing is. So what they're trying to do is hold that EM as steady as possible. And this greatly affects the theta calculation. One of the reasons that you get that volatility crush is because they're blocking the days. They're blocking that that move. And as soon as the report comes out, they pull that block out of the way. They pull that dam out. And now suddenly all of that theta decay and all of that volatility comes flying out of this thing, right? Because now they're going back to the regular square root of time formula and everything tries to come back to where it's supposed to be. And you get this massive crush in the pricing of those options. I kind of went through this fast, but it is recorded. I'll make sure it gets uploaded. And what I would like, if you're interested in this kind of stuff, is go back to this page, to this place where I'm on Think Back, and dance through these weeks. Take it back to January 1, right? Like take it back to January 3rd and look at the cost of these options right now. $9 at the money. Okay, right? I mean, that's not too bad. Kind of split the difference, call it like $9.35, $9.40. In 1 week, what's that option worth? And don't even really try to focus on what happened to price yet. What's that option worth? Price went down, by the way, between this week and the next week, and that option is worth a lot more money. Wait, we went down. The at the money option, at the very least, should have stayed the same because we're talking at the money, right? It's the aggregate value of how far this strike is away from price with intrinsic and extrinsic value tucked into it. How did it go up that much? IB. So just be careful with earnings. Don't assume that the trick is already in the bag or that you know what this thing is going to do. You can mark your ranges out. You can very clearly identify in advance, like it's got this much of an EM and it has this much of a market maker move. And that can help you land your strikes so that you can, like build iron condors, put on skewed butterflies, or just straight up put butterflies there. What you don't want to do is within 10 days before and 10 days after, you don't really want to mess with any kind of spread like a credit spread. Because remember, those credit spreads, they're going to get hit by the Greeks. And you don't want to put on any trade that's going to take a volatility crush, because this thing is going to crush, and it'll crush for days. It's not one day. It's going to take multiple days for this crush to leave the market. The good window is 10 days on each side that there's going to be a volatility crush. So give it that room. For stocks and things like that, if we're not talking options and we're just talking stocks, that's a more of a lean into what we think it could do. You can earnings whisper, places like that, use the earnings tab and other places to kind of give you a little more of a heads up. Also look at their peer group. This is a chip sector. What are the other chip sectors doing? Notice how AMD was blowout. What did MU do? Kind of look at the other names. Not necessarily safer, but remember that the expected move isn't taking into account the market maker move, right? So you want to make sure you put that in there, because it's not in there, right? So you got to put that in. A really easy way to do it, and it's how I like to do it. If you go to the risk graph with no trade on, just go to risk graph, set your date. So like we want Saturday. This is the expected move between now and Saturday. And it's a 1 standard deviation. So I can set these lines to a 1 standard deviation. And that would give me a good idea of a 68% probability move. But I want that market maker move, right? And I don't want to have to sit here with a calculator, because, during the day, we're busy. We want to be able to make decisions quickly. Set your probability to a 3 standard deviation move. Set your lines to a 3 standard deviation move. I don't need the at the money, so I would just go in and get rid of that one. And now we've got the outside boundaries of each end. Set that to the chart. There are my 2 lines. That's my high and my low. From that, take it into the intraday. There's my lines. Not that price level. That was me scribbling earlier. But there's the lines, price, slice. And we know it's the lines that I sent because it has the words price slice in it. If I delete these lines, for an example, just get rid of everything that I've ever drawn, and we go back in and we do that again, there's the lines. So this will give you a visual cue, and it's a 99% probability that price will stay inside that range. Now, remember, earnings are a period of time where markets can and are expected to exceed their expected move. It's when we get surprises that it does that, right? So take Google for an example. Google did better than its expected move, mainly because it wasn't just earnings. They also mentioned that stock split. So if we go to the think back and we look at what Google was on Monday before they announced, they had a $136 expected move with a $118 market maker move. So we'll just round up. It makes things easier. We'll call that 170 and 120. That's 290. It's a $290 expected move up or down within 3 days of its expiration period, Friday. So we could plot that out on the chart. We can't send this over to the risk graph now because it's already been too late, but we could have done it by drawing it out, right? If it was during that time period. So, you know, from, we're looking at Monday's close on this one, right? Because it's February 1, Tuesday, excuse me, Tuesday, February 1. We may even want to go back one more day because technically speaking, that was earnings day. This data is from after hours. So maybe it would be fair to go one more day. And that would give us a 160 and then the 120 there. But either way, you could take that and just take the line and move it 300. Yeah, about 300 points. From 2,700 to 3,000. That was its expected move between the start of this week and the end of this week. For the actual date, that square root formula, we do kind of have an indicator. This runs that square root of time formula and then places the range for the day using words like probable and implied. So the probable range is in gray. The implied range is the greater one. There's Qualcomm. And so far, even though it looks like a blowout move, it wicked outside of the range, but it's still in the range. Square root of time. So that's a wrap, guys. I'll try to make sure that this gets published as soon as possible. I don't think it needs to go next level library stuff. We'll probably just have it posted out onto the YouTube. And that way, you know, we'll have it for next time. Questions? I know I ran through it kind of fast, but I've gone through it before, you know, so to me, it's like rehashing old stuff. I wondered, I seen that you left. I thought I was boring you and you left. I used to be really excited about earnings. You know, I always wanted to put on like those lottery plays, some kind of YOLOs. And yet, honestly, the best earnings trades I've ever put on were butterflies. They do the best. I mean, out of every kind of trade that I've tried to use, butterflies are like the best way to go. I know, right? If you look at the pricing model, it's not that bad. But you know, when it I was watching Facebook, I've got a sweet spot for Facebook earnings. I'm telling you, this was the very first one that I'd ever seen get just annihilated on good news. I was really just shocked. You know, it was the first time I'd ever seen that happen, and I didn't understand, like, how can you give good news and still go down? We're at 253 right now. Take that out to the daily chart. 253 is way down here. I know, right? This is going to be a good play back to the upside. I will be selling options on this. Oh yeah. No, we're gonna wait a couple days. Um, you could, because of that volatility crush, you totally could. The reason I want to wait is these are really, they're going to be costly. You know, when you sell an option like selling a put, you're basically making a statement that says I'm willing to buy 100 shares of your stock. $250 a share, 100 shares, that's a lot of money. I don't want to tie up, yeah, right? A big baller, bro. I don't want to tie up that much capital. If I happen to get challenged and then need to roll it once or twice, I could get stuck in it the whole quarter, tying up all that capital, and then I'm kind of limited in anything else I could trade. So, you know, yeah, I'm going to be selling puts in it. I don't know if you wanted to do like a credit spread, you would definitely want to wait out of that 10-day window or choose options farther down the road, right? Like when we talk about that window of time, you just wouldn't use anything in that 10-day window. You could easily put the trade on tomorrow and go out to like March or April and put on your credit spreads out there. I have a credit spread in Facebook right now that I didn't close. I've been carrying it for a long time and it's destroyed. There's absolutely no salvaging it. And I had already salvaged it once. I've been in this thing like forever. And it's really big. And now I'm really trapped in it. The break even for the trade that I'm carrying right now, let's see, I have 345, 355, and I collected 535 in credit. So that gives me a break even of 350 and some change. That's the trade that I'm carrying. Oh yeah, it's completely and totally destroyed. The best that I can hope for is, since that's 1 year out in January, I'm going to hold on to it for a while, and then I'm going to attempt to roll those strikes down. I already had been holding it for a while. I've been in that trade for a long time. It originally started as a butterfly. The butterfly was losing. We took profit on the calls, kept the puts. And at the time, it was right on the edge of being like, okay, like everything was going to be okay. And then it had a massive drop and it wasn't okay anymore. Yep. So that's my bag holder. I'm just holding that thing. You know, eventually someday, maybe it'll fix itself. No, I'm going to have to roll it. You know, that's the way it goes. I'm going to have to roll it and slowly pull money out of it until it gets back above it. It is a trade that can be fixed. That's the most important part. I can fix it without putting more money necessarily into the trade. Just got to give it a little bit of time to come back around. One good up day and I'll get a roll in that thing. So just approach earnings with caution. I know I've seen a lot of people do so no, my original trade was a my original trade was a butterfly, and the butterfly was completely underwater. We salvaged it by closing the call side for, well, actually I rolled the call side up a couple times. I got a lot of profit on the call side, but eventually I closed it and I kept the puts as the credit spread that they are, and I rolled them down the road. But it yeah, it just got worse from there. Even though I've rolled it, I mean, I'm still holding a fair amount of credit in that trade. It's just every time I roll it now, it's going to have to be, I'm going to have to sacrifice more of that credit. And I may end up doing something else with it, you know, like turn it back into a butterfly or something like that. I'm not quite sure what I'm going to do with it. So that's a wrap, unless you guys got any more questions. GNRC, huh? Oh, wow. Well, the trend is definitely intact. It's got a 5.5% expected move, or an average daily range. Not much sizzle in there. What whacked that thing so hard to the downside? Oh, bad earnings, huh? Alternative energy. You know, a lot of those alternative energies got whacked. I don't think I would give up on it, though. What kind of trade you got? I mean, if it's something that could be managed, you know what I mean? Like a lot of our options trades, we don't have to just take the lump. So we can roll them, adjust them, turn them into something else. The Jade Lizard is a good way to go. Oh, well, heck, I mean, yeah, if you've got calls or if you've got shares, I would definitely be running some calls, especially if this thing has any volatility in it. Okay, so it don't have weeklies. That's not a great thing, but it's not necessarily a turnoff right off the bat. Suppose we went like to December and we priced what a 390 call would get you. You go in and you sell a call for the 390 area. And remember, you're not really going to give the stock away for 390 necessarily, but if you had to, you could, right? But we wouldn't want to. If you was to go to December and sell a call and you could sell it for around $16, hold it for maybe 3 months, buy it back, do it again, buy it back, do it again. You know what I mean? Like this isn't your final number. This ain't the price. This ain't price ain't right. But it's a start, right? And you would just keep cycling it. And if you have enough of them to do more than one covered call, sprinkle them in there in different expirations. The reason I say that is because the way that our minds can't comprehend the 3D nature of the Greeks, right? Like it doesn't just run up and down the options chain, it runs up and down the options chain through time. And it's really hard for us to visualize that. But what we can visualize is the cost that we're getting. So when you go in and look at what you could earn by selling a call, check multiple places. Sprinkle them in different locations. I'd like to come into the front a little bit as long as I'm getting something for my money. You know, so maybe even though you wouldn't want to get rid of it at like the 350 area, you're looking at 100 days out, throw on a 350, sell that one. You're still making like $700 on it. Hold it for, you know, maybe like 2 weeks, dump it. Maybe you only get 200 out of it, right? But one, it keeps you engaged. So you're like, quote, not necessarily day trading, but you're getting in the market, getting out of the market. You're staying engaged with options, which are a good way to learn them. You're making money on the bags that you're holding. And if this thing makes a significant move, the options are really going to shift and you can hit like 50% fast. For a while, we were getting a lot of negotiation in the options volatility. There were days where I would sell an option and in the same day, I was beyond 50% profit. He's like, wow, that was great. Thank you. Just rotate it out. I've been day trading options in Apple short because I've got these Apple calls, and just to make money on them because my Apple calls are down, I've been going in and selling options on that. And then it had earnings and blew up real big. So now I'm holding some short options, but I was nimble and getting in and out on a day-to-day basis. Yeah, I mean, it just keeps us engaged. Besides, if you're holding the stock, at least by selling the options, you're getting some money on it. You're getting some reduction in your overall share cost, whatever that cost may be. Suppose you bought it when it was at 450, then every single time you make another $100, that's $1 off of each share that you got. What if you have 100 shares? But oh yeah, I mean, I would be nimble about it. You can come into the front, but you're not really going to get a lot of, you know what I mean? Like, you're not going to get a whole lot of credit unless you're willing to threaten the market. The closer in time you are, the more likely it is you're going to get challenged. So if you're busy, say you have a day job, the family keeps you busy, that kind of stuff, and you're like, well, I just don't have the time to be dedicated, then sure, go farther out, go to like August, June, give yourself that room so you don't need to be so dedicated. If you are nimble and you're at the PC every day anyways, you're like, whatever, I'm here. Sure, come in a lot closer. That way you can be really engaged in the market and making that money back. I've had long trades, like I bought Amazon call and that thing was down, $7,000 at the end of the day. By the end of the week, I made way more than that 7,000 shorting the call that I was in. And then in the next week, that call went back up and I made profit from that too. So, depending on GNRC, this is a pricey company and these options are very expensive. Sell them. They're expensive. Sell them. Make money on them suckers. Yeah. Yep. 100 shares is what you need. There was a period in time where you didn't need 100. They were trying out this. They were experimenting with like less than 100 shares, but they gave up on that stuff. Every once in a while, you'll see this really old video on YouTube where somebody's talking about, an option, a half of an option or some weird stuff like that. I don't think I would wait. No. At any point in time, you could sell the options, right? So like tomorrow, when the market opens up, you could come in and you could just decide that you wanted to sell a 350 call tomorrow. You know what I mean? Anywhere. So 135 days out, we sell the call and we try to get around $1,000 for it. And between now and the next 135 days, if we stay underneath the 350 the whole time, this thing is going to just decay, and you buy it back cheaper. Even if you get challenged, like even if it starts to run at you, the expected move is $71. We're at 280. 280 plus 70, that is the 350. It would have to make every bit of that expected move. And it's supposed to take 135 days to do it. So if it starts running at you, it's not going to hit you. 350 may be your entry, but that doesn't mean you actually have to sell the 350, right? Because you have stock, not an option. You can sell whatever strike you want. Here's the thing though. If you're worried about being challenged, make sure you only sell an option equal to what you bought the stock for, because then you're not ever going to lose. You're in a no-lose situation. Here's why. When you sell a call, you're entering into a contract, right? Just like buying a car, buying a house. It's a deed. It's a contract. When you sell that call, the contract states, I will sell you my stock at this call price. Well, think about this for a minute. If you sell the 360 and you bought it for 350, you made $10 a share. And if you get assigned, meaning they take your stock, they're doing you a favor. You bought it at 350, they're taking it from you at 360. Here, you can have it, take it. I don't want it. So you wouldn't even have to worry about getting challenged. Let it challenge you. Go 16 days out, sell the 350. You're only going to make, $85. Not a lot of money there, but you wouldn't have to worry about getting challenged. I don't like this one, by the way. This does not have weekly options, so you're going to want to make sure there's actually some juice in it, right? Even if you go in and do something like the 320, it doesn't mean you have to give them your stock. If you start to get challenged, roll it down, roll it out. Dude, you got a lot of choices. There are times where I sell them in the money. I don't care. They're not going to assign me at 135 days out. I'll sell it in the money because this has inherent value and extrinsic value, even in the money. So for an example, here is Qualcomm. The at the money is this orange line. So this lighter shaded gray is in the money, and the wider area is out of the money. If I look to sell the 185, that's in the money. But that in the money call has $1,225 of extrinsic value, meaning it's going to lose that value. Even if it is in the money, time goes by, it's going to lose that value. Now, it may gain value because price goes up, but it will decay this much from the decay of volatility in time. So we can even sell in the money options and then buy it back when the decay drops. This is a really good way to do things when we get these V-bottom lows. During the earlier part of the morning, when you have one of those V-bottom days and the market's just ripping to the downside, and then you go in and you sell a call on the start of the rally back out, right? And everybody says, well, no, don't do that. You're selling a call on top of the market in front of a rally. Yes, you are. But when it's rallying back up, that option that you sold is losing volatility like crazy, and its value is just dropping like a stone. Now, if you're too short, price is going to run you over, but that's a whole separate issue. We already know what a normal average move is. Just make sure you're selling the call beyond that daily average move. You're good. So it's a really nice way to make a little extra money on the side. Selling options is a whole lot easier than buying options. It's easier to be right. You don't have to be so quick on the draw, and you can make a heck of a lot of money doing it. I love selling options. You do have to have a pretty good size account, or you're stuck selling options on really cheap stuff. And there's nothing wrong with that for a learning experience, but you wouldn't want to do that all the time, right? Because there's just no money in it. But if you go to like the under $10 list, and then you go in and you sell options against that list, it's a pretty good list. A lot of companies have options that are below $10. Yeah, especially if you know you're not looking to get out anytime soon. Another thing is like investors. So one of my coaching clients for a while, they were a couple, a man and his wife. They both worked at AT&T, and they were retired. So they worked there for like 40 years, and they own a lot of AT&T stock. Well, until recently, that was a really good stock to sell options on. Before the Corona crash, the guy was selling calls, and then Corona hit, right? So he sold calls here, and then Corona happened. Well, obviously he wasn't getting challenged. He rolled those calls for a year, just kept making more and more and more and more money on it. And they did not ever want to get rid of their stock. He still owns the stock now. They have 40 years of stock from AT&T given to him for free. The guy's just making money on free money. That's awesome. I like free money. So, you know, we all got something, whatever it is that you happen to have. Think about ways that you can turn the trade into something else. You know what I mean? Like, it doesn't have to be this losing thing that just makes you want to throw the computer out the window every time you look at it. And Facebook got whacked, man. I'm excited about the possibility of going in and trading some options on that. All right, everybody. It's a wrap for me. I'm gonna get off of here. Enjoy your night. I'll try to make sure this gets posted onto the YouTube for everybody, and we'll call it quits.